Welcome back to the presentation of Fixed Income Valuation Part 3 and the concluding part for CFA Level 1 candidate 2021-2022. In the Part 1 and Part 2 of the video on Fixed Income Valuation, we learned about the basic elements of Fixed Income Valuation. We also learned about what is called as the YTM and how to derive the YTM given the spot rates. We talked about the interest rate volatility and how the interest rate volatility acts as the market shocks across different term structure. And we also did a few problems regarding that in order to glean out the concepts underlying it. We also discussed about what is meant by the reference benchmark and how the yield to maturity gets built in by different elements of it, namely the credit spread, liquidity spread, so on and so forth, and how they are stacked up. Now, the part 3 of the video will conclude the rest of the portion of this fixed income valuation lecture. So, to begin with, there are actually 5 yield measures also which you need to understand. One is called the street convention, wherein we talked about the day count convention in case of a corporate vis-a-vis a government bond. So in case of a corporate, it is 30 where 360 convention that is being followed, while the government bond is measured into actual by actual convention. The street convention is wherein you ignore the weekdays, weekend days in the day count, and the true yield would include that. And the government equivalent yield considers 3360 as we already know, and the current yield. So the current yield is nothing but the sum of all the coupons, ignoring the frequency of the payment of those coupons. So in a year, the 10% coupon can be paid 5% semi-annually, 2 times a year. So we ignore that and we directly take 10 as the total coupon that is being paid throughout the year. So whether it is being paid annually, semi-annually, or even quarterly, that would not matter. So the sum of all the coupons in a year divided by the current market price is the current yield of a security. The simple yield is basically sum of all the coupons. It is an advancement. It is actually an improvement over the current yield, wherein it sums up all the coupons received in a year regardless of the frequency, and also the amortized gain or loss of the face value. The amortized gains and loss of a security is basically the amount of the security that is being retired every year by the issuer. So we have discussed a portion of it in the preceding chapters. In the following chapters, we are going to talk in detail about those amortized gains and losses. For now, suffice to say that this is the formula, and it's pretty easy actually to to memorize it or to understand it, in fact. So let's take a quick example in order to collect all the concepts together and elucidate. Given here is an exhibit that I have directly picked up from the CFA Institute textbook, and I have improvised on that. So you have a couple of bonds, bond X and bond Y, the annual coupon rates of which are 8% and 10% respectively. The frequency of those coupons are twice a year, that is semi-annual paid, and bond Y being paid quarterly. Bond X has a maturity of 5 years, while bond Y has 7. The current market price is 97 for bond X and 94.5 for bond B, bond Y. And now we need to find out what is the current yield, the yield to maturity, and the risk premium that is attributed to the liquidity portion of it. So remember, we talked about how the YTM is a function of the benchmark yield plus the spread measures, and the spread measures are stackable in nature, starting with the credit, then the liquidity, option, maturity, modeling, the business cycle, and the inflation, CLOMB, the abbreviation of which I had explained in the preceding video. So this portion is to be found out. Okay, so let's dive into the problem right away. The Current yield is nothing but the coupon itself, as we have discussed. So it will be, for bond X, it is going to be 8 divided by 97. So that measure comes out to be somewhere around 8.24%. Similarly, for bond Y, it is around 10 divided by 94.5, which comes out to be 10.58%. So this is the current yield. The yield to maturity, well, this is a simple TVM problem, and I'm sure that you would be able to do it yourself as well. All that you have to do is to input the details. I'll do it for bond X, and the rest for bond Y, you should do it for yourself. So in case of bond X, which has a frequency of 2 and maturity of 10, that means N is going to be 5 into 210 periods. The interest rate, that is the yield, that is what we have to find out. The present value of this security is pegged at 97% of the face value. The face value by default is 100. The coupon being paid at each interval is going to be 4. So if you input all of these details and ask the CalC to find out the I by Y, the I by Y will come out to be 8.75%. This is for bond X. Similarly, if you do the exercise for bond Y, the yield to maturity will come out to be something close to 11.14%. So we fill in these details here. So bond Y, it is 8.75%, and bond Y is 11.14%. Up to this, it is fairly easy. Now we have to find out the risk premium that is attributed to the liquidity portion of it. So for that, we will have to refer to the additional notes being given. So the additional notes, there are 3 notes that have been given, that bond X is written BBB while bond Y is rated B. Naturally, you may understand that bond Y is lower rated security as compared to bond X. And the credit spread between the two ratings is 100 points basis. The maturity premium for bond Y is 69 basis point over bond X, and the sector inflation is close to 40 basis point over bond Y. So given this, we have to find out the risk premium attributed to the liquidity portion of it. So let's just do it. We'll simply write it down. So on bond X, which is rated BBB, and bond Y, which is rated B. So the difference between the credit spread between the BBB and B is 100 basis point. So we simply say that change in credit spread is, we write the difference in this column, or let's say we write it here. So that is 100 basis point. So 100 basis point would mean that bond B yields 100 basis point or 1% more than BBB rated bond X, because it being a lower graded security. The maturity premium, as has been stated, is 69 basis point. The bond Y has a maturity of 7 years, while bond X has a maturity of 5 years. So bond Y is again compensated for the higher risk of uncertainty for the additional couple of years. So that's being mentioned at 69 basis point. And the sector inflation for bond Y is another 40 basis point. Okay. So if we add all of this, this comes out to be 209 basis points. Okay. Now, the yield difference, the overall yield difference is simply 11.14% minus 8.75%. This is expressed in percentage. If you multiply it by 100, it is going to be expressed in basis points. So overall yield difference measured in the YTM difference is around 2.39%, or let's say 239 basis point. So what is the liquidity premium? So the liquidity premium that the bond Y commands over bond X is now fairly simple. All that we have to do is to deduct this 209 bps from this 239 bps. So that comes out to be close to about 30 bps. And that is your liquidity premium for bond Y. So in exam, you might be presented with this kind of table as well, and you have to do this calculation. This is very simple calculation. All that you need to understand are the components that make up the yield to maturity. Okay. So next in line is how to measure the yield for bonds with embedded call option. As we know before that, a couple of things we rehash once again, that the call option accrues to the issuer of the security. What it means is that the issuer has the right to call the bond should he so believe that the bond is priced way too premium as compared to the market standards. So that would mean that the issuer could have issued a security at a lower cost. Hence, it is profitable, it is justified to call the existing security in the market if the value of the security in the market has gone up manifold than the comparable securities in the market. To protect the issuer against such spike in the bond valuation, which is detrimental to the issuer embeds something called as the call option, which provides the right to the issuer to call the issue at its discretion should the market interest rate fall substantially. Now, since the issuer is buying in this call option, it must also compensate for this call option in the form of premium, and the premium gets adjusted in the form of higher coupon or higher yield, one of these two. Okay. Now, while the issuer enjoys the call option on the issue, we also must understand how the market prices this security vis-a-vis a straight bond. Now, in case of a straight bond, the price yield relationship holds pretty fairly. That means that if the interest rate or the yield of the security increases, the price of the security would come down proportionately. Okay. Reverse is the case when the interest rate or the yield of the security decreases. This we know that this price yield graph is pretty familiar to you. It should be pretty familiar to you. And the linear measure to find out that is through a metric called as the duration. Duration measures the sensitivity of the issue with regard to the rate of change of interest rate in the market measured in absolute terms. All right. But when a bond has an embedded call option in it, it does not behave so properly, so uniformly when the interest rate comes down. Why? Because when the interest rate comes down, the bond, which otherwise should have increased proportionately, it does not happen in this case because of the strike price of the call. So in this case, the market will not value this security beyond the call price itself, which means if the issuer has already depicted his call schedule, so the market will not value the security beyond that value, because the market pretty well understands that beyond this price the bond will be called. Hence, the maximum value, the value is capped at the strike price of the call itself. Now, is there a hard and fast single digit strike price that is of importance? No. In fact, there are a series of strike price in which the issuer may actually call the issue, because it also may so happen that the issuer may not recall 100% of the issue at one go. It may decide that 50% it would call at a particular level, the rest 25 at another level of yield, and the rest 25 at another level of yield. It serves the purpose of market sanctity as well, because it might also so happen that the spurt of the interest rate that was being noticed on the negative side, that means that the interest rate actually came down, that could have been momentary, and then after some time the interest rate goes back to its normal scenario. So in this case, the issuer may not be in a position to call on the entire issue that's outstanding in the market. So by this, it provides a certain leeway to the issuer to test the market to see whether the interest rate is progressively declining. And if it so happens, then the issuer would succeedingly like to call on the issue based on the proposition. The other way around, the counterparty to this is the investor as well. It serves the purpose of the investor as well, because the investor also will not have to bear with the entire outstanding being retired, on which he was enjoying the higher coupon or the higher yield, which was the price of the call option. So for him as well, it becomes the investor, from the investor's perspective as well, it serves the purpose beautifully, because he will just have to part with 50% of his holding, and then as per the call schedule, if the interest rate does not decline further, then there is no question of the rest of the securities being called, and the issuer still would enjoy the outstanding coupon, enjoy the enhanced coupon or enhanced yield on the outstanding principal that he would have. So it serves both ways. Because this happens in the market, because the sanctity is to be retained in the market, so the issues are called as per the call schedule. So the call schedule is also designed and is being mentioned in the bond indenture as well. So let's take this example. Let's say that we are talking about an issue which has a total tenure of, let's say, 15 years. It's an annual pay issue with a call option being embedded in it. Now, it might so happen that the first 5 years, the issuer may not have the right to call the issue at all. Okay, so in this first 5 years, the issue may exactly behave like that of a straight bond. But beyond that period, there would be call schedule that is attached to it. The first is, of course, the yield to first call, yield to second call, and normally by third call itself, the issue is completely retired, which is also called the yield to worst. Now, an issuer, as I mentioned, that in this case, as per the call schedule that's been given, in this case, the issuer may actually place the highest bet on this issue. So the issuer may call the issue at 105% premium, 105 for every 100 face value of the issue, because this is the first call. By the time the second schedule comes in, it might be 103%. And by the time it is the yield to us, it might be only 101% of the face value. Now, why is it so? Again, it is closely tied up with the price yield trajectory and the glide path that I explained in the preceding videos, that if the call was not made, in any case, this issue would finally gravitate towards its face value. So it does not actually quite play out in the favor of the issuer if the issuer maintains the same call price. Yes, the first time around, when the market has declined, market interest rate has declined substantially, the issuer may entice the buyer and hence may place a premium over the face value, because he might think that the subsequent interest rate regime may further decline the interest rate, and in that case, the price of his issue or the market value of his issue may actually go northward of 105. It might become 110 or 112, as the case may be. To protect himself against this upward surge of the valuation of the outstanding issue, the issuer will place this call schedule, and as I said before, that it balances both the parties' interests, and as per this call schedule, the issuer will retire the bond. The one case one contingency aspect that we must not forget is that the bond investors, the bond holders, will not have any say whatsoever. They will have to comply with the issuer's legitimate demand. So if the issuer is making a call on the first date for the 50% of the issue, the bondholder will not have any choice but to retire this 50% of their holding at the rate given at 105% or 103%, whatever be the case. Similarly, the rest 25% may be called at 103%. So in short, they will have to comply with the bond indenture call schedule, as the case may be. So again, this is a very, very important concept. As I said before, that how strong you build your foundation in L1 will help you how fast you are able to complete your CFA program and have a very solid understanding up until your CFA level 3. Okay. So this is all about the call schedule and the call option that is being embedded in a callable security. So let's now talk about the credit spread changes and how they actually affect different options, different securities in the market. Well, before that, I would like you to take a small note on the floating rate note as well. So at the core of it, the floating rate note were devised in such a manner to price the security at par at any given instance. Why is it so? Because it protects the bondholder against the market volatility of interest rate and thereby retains the face value of the security at every resetting or every coupon paying date. Now, as I said before in my preceding videos and in preceding lecture, that there are different kinds of investors in the market with different level of risk appetite. And it is for the supplier of the financial securities to meet those demands in order to create a balance in the market. That's how trade happens. That's how investment happens. All right. So the floating rate note would adjust themselves to the changing yield structure with respect to the benchmark. Adjustment happens every resetting date. Now, here I'm going to introduce a couple of more concepts here, what is called as the quoted margin and what is called as the required margin. Okay. Now, suppose when the issue was first floated in the market, the benchmark yield was somewhere around, let's say, 5%. Okay. And the issue is rated at triple B, which still is an investment grade, which would warrant an additional yield of, you remember those stackable yield measures? So additional yield of another 200 basis point. So that would mean this issue will be priced at 7%. Okay. So this 7% would mean that when the issue is first floated in the market, it will be priced at its face value itself at 100 because it's a floating rate note. So here this 2%, 7% minus 5%, this 2% is the initial spread that the issuer is ready to provide in order to price the security at its face value. Hence, this initial spread is called the quoted margin. So the quoted margin is this 2% or 200 basis point. Okay. Now, at every resetting date, the market interest rate is likely to change. If the market interest rate remains same, then the quoted margin will remain same. Obviously, the quoted margin will not get altered. But suppose what happens is, when suppose the benchmark yield or the market interest rate, which is devised on the basis of the treasury securities, from 5%, let's say it jumps to 6%. Okay. So then what has happened is that because of this 1% increase in the treasury security or the benchmark yield, the security under consideration would also undergo another 100 basis point upward movement. Okay. So then here it will become, instead of earlier 7%, this will become 6% plus 200 basis point, which is equal to 8%. Okay. So now the security will be priced at yielding at 8% as compared to yield as it was earlier yielding at 7% at the time of issuance. Now, if it yields 8% at the next resetting date when the market interest rate climbs from 5% to 6%, evidently this equality will be maintained and the issue will still be trading at par. Okay. Now, what was the adjustment that was required? The adjustment was required to enhance the yield of the security by 100 basis point by 100 basis point because of the benchmark interest rate being increased by 100 basis point. So long as this equality or this adjustment is retained, this treatment is maintained, the status quo will be maintained and the issue will still be trading at par. Now, in this case, this additional 100 basis point is called the required margin. Okay. So this is where you need to understand the difference between the quoted margin and required margin. At initiation, that is at t is equal to 0, the quoted margin by default is required margin because the issue is supposed to be trading at par. It's a floating rate note. At subsequent date, when the coupon is being adjusted or the resetting happens, the required margin is the one to which the issue must comply in order for the issue to still be tradable in the market. Now, in this case, how this required margin gets adjusted, it can get adjusted in a couple of ways. One is it can either increase the numerator. Numerator is basically, as we have mentioned before time and again, the present value of a security is nothing but the summation of the cash flows. So the cash flows are reflected in the periodic coupons that is being issued. So one of the two ways the issue may get adjusted in order to retain the required margin. A, it increases the coupon. So for example, suppose the same security which was earlier yielding 7%, now it has to yield 8% because the market interest rate is increased from 5% to 6%. So let's imagine that it was also at that point in time was giving a coupon of let's say 5% in the market. Okay, so the security is priced at 7% and it is giving a coupon at, let's say, 5%. So in this case, the issue will still be floating at par because it is retaining this yield to maturity thing. Sorry, it has to 5% plus 2%. So the coupon is, let's say, 7%. Okay, so it will be issued at par and it will be floating at par. So when the market interest rate becomes 6%, the yield of the security immediately jumps to 8%, and the coupon is being adjusted to match the yield. So in this case, the discount factor and the coupon enhancement both have undergone the same amount of change. Hence, the status quo is being maintained. So here what we are doing is we are adjusting the coupons. Okay, so we are adjusting the coupon from 7% to directly we are making it 8% in tandem with the increase in the market interest rate. There is one more way to do the same problem, and that is by enhancing the principal itself. So suppose, let's say, when at issuance you had actually invested $10,000. So this $10,000 is your 100%. Okay, so when the market interest rate has gone up by 1% out here, all that you are doing is that the issuer may increase the face value from 10,000 to 10,000 plus 1%. So it might become, your principal now becomes 10,100. On this, the same coupon of 7% if you apply, that is supposed to yield you the same amount over the period of the tenor as an 8% coupon would have yielded to you in order to maintain the status quo. So in a nutshell, all that I'm trying to tell you is that in order to maintain the status quo of a floating rate note, so that the present value of the security and the fair value of the security is always retained at 100%, we can do the adjustment. The security can do the adjustment in a couple of ways. Either it can adjust the coupon, which is actually the numerator of your cash flows, or it can actually enhance the principal, which is to be paid at the end of the tenor. It can adjust the principal accordingly, leaving the coupon unchanged. One of the two ways it can be done. Okay, now in either way, the required margin is still at 100 basis point more than the quoted margin which was earlier. Okay, so these are the couple of things that which you need to understand. because this required margin is again going to be reflected in the denominator, which is the discount factor. So if you do this adjustment, the status quo of the floating rate note will be maintained. Okay, so this is the whole crux of the matter of it, which I wanted all of you to understand about floating rate note and what is meant by the quoted margin and required margin, and where lies the difference. Okay, so one gets adjusted at the numerator, another gets adjusted at the denominator. One gets adjusted at the coupon itself, another gets adjusted at the principal value itself. So that's how it happens. Okay, now regardless of the security being a fixed rate coupon paying bond, straight bond that is, or a floating rate note, the credit spread change will affect the security in similar manner. Okay, because credit spread, remember, credit spread is a function of the security itself. It is not the function of the benchmark. So whatever is whatever gets changed at the issues spread, that can affect the issue in an equal manner. In the impact of that change is going to be equal regardless of it being a straight bond or a floating rate note. Okay, and as we mentioned that in case of a fixed rate, coupon changes are reflected in the interplay of coupon and the YTM, while the change of the floating rate note is reflected in the interplay of the quoted margin and the required margins differential. Okay, so this is an important derivation that you all need to understand. For brevity's sake, I'm just putting the equation back for the same cash flow. So let's say I have to value a floating rate note. So the notation of the floating rate note, the fair price of the floating rate note today is nothing but the coupon that is being issued. So the coupon that is being issued initially is nothing but the benchmark yield plus the quoted margin. So this is the coupon that is being issued, and here you're going to discount it with the required margin. So in the next resetting date, the benchmark yield plus here the quoted margin as it was there, now it may undergo a change in order to keep in tandem with the required yield or the required margin. So this quoted margin will remain as it is as before, with a small change here, either plus side or on the minus side. Okay, and here also it remains the same with either the plus side or the minus side. Okay, and so on and so forth. So the crux of the matter is that to ensure that the equality is maintained, the status quo is maintained, wherein the present value of the security is the face value of the security, which is 100%. The adjustment that is being done at the initial point at the floating of the issuance of the security is called or governed by the coupon itself, and the numerator, that is called the quoted margin, and the subsequent adjustment is being done at the denominator with the required margin, as well as the numerator with the quoted margin and the differential being plugged in here. Remember, as I said before, that this differential, the coupon may be left as it is as well, and this quoted margin can straight away be taken at the extreme end of the principal adjustment. So these are the two ways, and the adjustment will be such that again this sanctity, this status quo is maintained. So this is the crux of a floating rate note. Okay, so let's take a quick example for us to understand what we are trying to say. So Beswell Samtel, a South African telecom giant, issues a 4-year semi-annual pay FRN with the following details. Okay, the benchmark rate being that of 6 months LIBOR, the floating rate note pays a quoted margin of 150 basis points over the reference rate at each resetting date. The bond was issued at par, but obvious, we're talking about a floating rate note. At the first resetting date, the credit quality deteriorated and the credit spread widened by 50 basis points. What should be the value of FRN on the first resetting date, assuming the 6 months LIBOR is at 7% and remains flat for the tenor? So let's first draw the timeline. So we are talking about 4. Okay. So it pays semi-annually. That means it will pay one coupon here, another here, another here, another here, another here, another here, another here, and here the last coupon and the principal. Okay. So when it was issued, the benchmark reference rate was that of LIBOR, and the LIBOR was set at 6%. And the FRN was quoted as 150 basis point over the reference rate. That means the yield of this particular security was slated to be 6% plus 150 basis point, which is equal to 7.5%. So this is the quoted margin was 150 basis point, which subsequently, when added to the benchmark yield, produced the initial yield to maturity of the security when it was issued or floated first time in the market. The bond was issued at par, which means in this case, since nothing else is mentioned, we will assume that the adjustment has been done in the coupon, which again brings us to the same logic that the coupon that would be paid by this particular bond across all its tenor until and unless there is a need for adjustment will be 7.5% per annum. Okay. So when it was issued, the coupon is slated at 7.5%. Okay. At the first resetting date, the credit quality deteriorated and the credit spread widened by 50 basis point. What should be the value of FRN on the first resetting date, assuming the 6 months LIBOR is now at 7% and remains flat for the tenor? Great. So a couple of things that we understood. First is that the issue has been floated at par. That means the present value, this FRN's present value is equal to the face value is equal to 100%. Okay. The catch to this is that the yield to maturity at issuance of this security as well as the coupon is 7.5%. But obvious, because if it is not so, then it cannot float at par. Okay. So the first coupon that would be paid is here, and it would be 3.75%, right? Because it pays semi-annual. Now, here, after this 3.75% is being paid, the market interest rate is reset to see what has been the change. And what it seems like that the new LIBOR at 6 months, okay, so this is the initial LIBOR. The new LIBOR at 6 months is for the rest of the tenor. So the rest of the tenor is 4 years until maturity. So which is rest of the tenor is at 7% and it is assumed to be flat. So if it is now 7%, what should be, in order for this FRN to retain its value, what should be the required margin in this case? But obvious, the required margin would have been now the initial 150 basis point, which was the quoted margin, plus this new adjustment of 100 basis point because the market interest rate has climbed from 6% to 7%. So the required margin immediately becomes another 100 basis point. Okay. But there is one more catch to it. And the catch is that in this case, the credit spread has also widened by 50 basis point. If the credit spread has widened by 50 basis point, and if the issue still has to float at par, because that's the property of a floating rate note, that means in the required margin, another 50 basis point gets added because of this additional credit yield. Okay. So now the required margin becomes 200 and 50, sorry, it becomes 300 basis point. Okay. Now, how it is going to be adjusted? So either what should the value of it on the first resetting day? So again, in a couple of things, if the issuer still wants it to retain the FRN's present value is equal to the fair value, is equal to the face value, and equal to 100% of it, then it must do the necessary adjustments. So how it will do the necessary adjustment? So what it will do is, instead of paying a coupon of 7.5%, it will pay a coupon of 9%. How this 9% gets adjusted? Because now earlier the coupon was 7.5%, which embedded this 150 basis point. To this, because of this sudden interest rate change of the LIBOR and another 50 basis point change in the credit spread, 150 basis point additionally get added to the existing coupon of 7.5%. So this becomes 7.5%, the coupon that was there, plus the additional 1.5%, this 1.5% I'm talking about. So 7.5% plus 1.5% is 9%. So now, in order for the security to be, to be floating at least at par, it must pay 9% coupon. So if it pays 9% coupon, let's see what happens now. So we have now got a security which pays 9% coupon semi-annually, of course. The yield to maturity, or the I by Y as we call it in our CalC, is now this becomes a 7%. So 7% plus the requisite 150 basis point of the initial quoted margin plus the 50 basis point credit spread, which is again 9%. So now we have got a coupon which is paying 9% and the yield to that is 9%. Now, irrespective of the tenor could be anything, doesn't matter, so long as this equality is being held, the issue has to float at 100. Okay. Now, couple of things that we must understand. What if the issuer does not pay the additional yield of this 50 basis point because it suffered the credit deterioration? So the bond, let's say the bond was initially, when it was floated in the market, let's say it was rated at BBB, but because of this credit deterioration, now it is being rated at BB only. So when this happens, that means in order for the issuer to again go back to BBB rating, we do not know, it may or may not happen because ratings don't change overnight, but at least the issuer will have to show its intent. And in order to show its intent, what it may choose, that it may choose to pay this additional spread of 50 basis point which it suffered because of the deterioration in the credit spread and subsequent rating downgrade. If it does so, subsequently the market will value this security back, and because it will be floating at par, and maybe there is a possibility that it will regain its status quo of BBB rating. This could be one of the motivation. The second motivation is that the issuer may choose to do nothing. In that case, what happens? If the issuer chooses to not do anything, in this case, the coupon will not become 9%, but the coupon will become 8.5%. It will only adjust the portion of the yield which is being compensated because of the change in the benchmark yield from 6% to 7%. Okay. So in this case, what has happened is that the required margin is still 9%. Remember, the required margin is nothing but the denominator, in the denominator which gets adjusted as the discount factor. The required margin is still at 9%. However, the coupon is at 8.5%. Now, if you do the math, wherein you put n is equal to, at the first resetting date, the number of periods remaining is going to be 7. The coupon is obviously going to be 8.5% being paid semi-annually. And the I by Y, of course, that will become 9% because this is nothing but the required margin. And the face value is equal to 100. What should be the present value? So we calculate. So if you input these details, so 8.5% being paid annually, that means 4.25 being paid every 6 months, while 4.5% is the interest rate. So this issue will now be priced at 98.5% of its par value. Watch how the issue is no longer a floating rate note that maintains the sanctity of the present value is equal to the par value or the face value is equal to 100. Why it is so? Because in this case, the quoted margin is not equal to the required margin. Okay, because in this case, the issuer chooses not to compensate the existing bondholder with the additional yield because it suffered this credit deterioration and it stuck onto the coupon of 7%, a coupon of LIBOR plus 150 basis points. So the LIBOR changed from 6% to 7%. So the issuer still is paying 7% plus 150 basis point at 8.5% coupon, but it chooses not to compensate the bondholder for the additional yield, chooses not to compensate the bondholder because of the additional credit deterioration. The market would suitably punish this issue, at least theoretically, which means that the issue should not, at least theoretically, be traded in the market anything upward of 98.5% of its par value. If it is so, the issue is definitely overpriced and arbitrage will definitely glean out the profit in order for the issue to trade at 98.5 or less than that. So this is how things do get built into it. I know it was a very long example, a long explanation, but as I said before, that I'm building the foundation for all of you guys, a foundation so strong that it can help you not only in your level 1, but complete your charter and level 3 as well, and will help you in your real world of working. Okay. Money market instruments are those instruments that have maturity of less than 1 year, and typically they are, if they are either issued by the government or the corporates. Now, the commercial paper, the T-bill, the banker's acceptance, these three instruments are quoted at something called as the discount rate, while the certificate of deposit, repo rate, quoted as something called as the add-on rate. Now, I don't want you to be confused and be intimidated with the terminology of discount rate and add-on rate. These are simple convention. I have drawn the graph for you to understand. In your exam, all that are going to come is basically comparing two instruments, one having the discount rate, another having the add-on rate, and then compare them and understand which is better to invest in and what. So for that, I just want you to know this formula, and all that you need to understand is that when you have to compare any instrument with another, one of which is being quoted in DR, another one is quoted in AOR, but obvious you need to bring them at some sort of equivalence level. So that would mean that you either convert the security that is being quoted in additional add-on yield to discount rate, or the reverse way, the issue that is being quoted in the discount rate, convert that into equivalent add-on rate, and then on an annualized basis you will compare and see which is producing higher yield. In exam, nothing more than this is going to come in your nothing more than this is going to come, and it is really very simple. So let me just I will reproduce what is being from the CFI textbook, and for clarity, for comparison purposes, there are two bonds that is being taken into consideration. One is A, another is D. These are of course money market instruments. Remember, money market instruments, they are not quoted in a compounded manner, but they are quoted in an annualized manner. So this is the only catch to this whole thing. So A is quoted at a discount rate wherein the number of days are 360 and quoted rates are 4.33. D is quoted at 365 days uh, day count convention, and the quoted rate is 4.45. So both of them carry the same amount of credit risk. If you were an investor, which one is a better investment tool? Okay, so very simple. All that we have to do is either we go from discount rate to add-on rate or from add-on rate to discount rate. The result or the inference at least are going to be same. So let's proceed. Okay, so when it is being quoted at 4.33%, so all that it is saying is that the present value, we are using this formula, is equal to 100 into 1 minus, since it's money market instrument, so it's a BEY basis. That means it's a semi-annual way of doing the thing. So this is being quoted at 180 divided by 360 into 0.0433. I've converted the percentage into decimal in order to find out the present value. All right, so here it's come out to be the present value of this security is 97.835. Okay, so now we take this 97.835 here, convert it in here, and see what the case may be. So we write FV, we have to find the FV here. FV by default is obviously 100. So 100 is equal to 97.835 into 1 plus, in this case, we have to convert it into the convention. So in this case, it becomes 180 divided by 365, okay? And we need to find out the add-on rate, which we do not know, okay? So if you solve this math, the add-on rate, let's see what it comes out to be. It comes out to be 4.48%. Okay. So what did we do? We simply took the A bond, okay, from this A bond, which was quoted at 4.33% on a discount rate basis with a day count convention of 360, that is, we found out the present value of that. And from this present value, we input it as if it were an add-on rate security. In that case, what would have happened? So in that case, what we did was we put in the face value, obviously by default is always going to be 100. So we put in the present value at 97.835, and we tried to find out the add-on rate. The add-on rate came out to be annualized at 4.48%. So between, now it becomes comparable. So this 4.33%, the equivalent add-on rate, see, this is quoted in discount rate. So the 4.33% discount rate, 4.33% discount rates, equivalent add-on rate is 4.48%. Okay. Now this 4.48% is directly comparable to this 4.45% of the security D. And we see that between these two, investing in security A makes greater sense because it is yielding 3 basis points more. Well, 3 basis points in general may not mean much of a thing, but imagine it being on a principle of $10 billion, and then you will get the math what I'm talking about. Okay. So can we do the math the other way around as well? Definitely, we could do the math the other way around as well. All that we have to do here is take this example and start with bond D. Okay, start with bond D and see how it looks like. So Let's do the math here, but we do the reverse way. So in this case, the add-on rate has been mentioned at 4.45%. Okay, so we put in the add-on rate here and we find out the present value. The objective is to find out the present value. Okay, so we put 100 is equal to present value at 1 plus 180 divided by 365 into 0.0445. Okay, so if you do the math, the present value will be 180. So this becomes 97.85, the present value of this. Okay, so we gleaned out the present value. Now from this present value, we will now find out the discount rate. So what do? We simply put in 97.85 is equal to 100, 1 minus. Now remember, since we're going here 180, now this will become 360 and not 365. We have to find out the add-on rate. So let's do the math. And the add-on rate for security D comes out to be 4.29%. Okay, so what we did in the earlier case, we started from the security A and we converted the discount rate's equivalent add-on rate and then we compared it with security D. In this case, we started with security D. We converted the add-on rate to its equivalent discount rate and we found out this is the discount rate, not the add-on rate. This is the discount rate. And we found out the discount rate to be 4.29%. Between 4.29% and 4.33%, of course, 4.33% is better, and the difference is again the same, 4 basis point. Okay, so either way you go, you will reach the same inference. So I think this example was detailed, and I hope that the concept should be amply clear. Okay, so term structures, let us understand a little bit of this. Spot rate, of course, we already are aware of what is meant by spot rate. And the spot rates are also called the maturity zeros. It is as if, I'll draw the timeline for you in order to understand very briefly, that as if, if let's say we are talking about a tenor of, let's say, 1 year, 2 year, 3 year, 4 year, 5 years. So there will be 5 different spot rates, starting from spot rate of first year, spot rate of second year, spot rate of 3, 4, and last is spot rate of 5. All that it means is that if you keep the security for 1 year locked, what it is going to yield, keep the security for 2 years, what it is going to yield, keep the security for 3 years, what it is going to yield, keep the security for 4 years, what it is going to yield, and keep the security for 5 years, what it is going to yield you. These are the spot rates. So you're not getting any interim coupon, you're getting a direct lump sum at the end of the maturity. That is what the spot rate is all about. Hence, they are also called the maturity zeros. Okay, so it is as if you have invested in a zero coupon security for the tenure that is being defined, whether it is for 1 year, 2 year, 3 year, etc. But they are going to be invested in the spot rates. Okay. All right. So why these spot rates are important? Because spot rates are the basic building block for taking out the benchmark yield, and the benchmark yield is again the reference point basis which the issue of a security's yield is determined. Okay, that is why the spot rate gets significance. And the spot rates, now the next important question is that spot rates of what? Of course, the spot rates of the most liquid securities and the government securities only. Why? Because they are default free. Since they are default free, the rate of interest that is going to be quoted on this is basically the compensation for the time value that you are holding on to the security. And of course, since they are the most liquid, hence they are being chosen. Par rates and par rates curve. Now, this is again one more important concept, and par rates are, uh, if you remember, okay, before that, I'll just touch base upon the YTM rate once again. So, what is YTM? YTM is nothing but, it is the um, it is the yield of a security. And most importantly, as we say that, we have already discussed that you have a reference, you have this spot rates, and basis the spot rates, you come up with a um, the benchmark yield curve, benchmark yield curve. Okay. So for tenor, which is from 1 year, 0th year, to tenor, this is 5 years. So different spot rates will ultimately give you this curve, this line. So basis this, if you have to find out the yield of a security, you have to only add the spread measures. This is the spread measures which we have discussed at length in our preceding slides and preceding videos as well. Okay. So this is when an issue is first floated in the market. That is how it is quoted, that it is yielding to maturity of, let's say, giving you 8%. Okay, so this 8% may be like this benchmark yield could be 6%, and this additional 2% is being 2% being the compensation for all these spread measures or all these risks put together, clubbed together. Okay, this is what yield to maturity is all about. However, what is meant by par rate and what is par curve? Remember, we talked and we spent a great deal of time in deciphering what is a floating rate note, and then we took a problem of what is meant by the quoted margin, what is meant by the required margin, and how the quoted margin do get adjusted, and the required margin also do get adjusted with either the denominator in the coupon form or in the denominator at the discounting factor itself. Okay. Now, all that you need to understand is that if you do the adjustment at the denominator, as we have mentioned before, then that yield is the par rate. It is as simple as that. Okay. If you do the adjustments, so we talked about doing the adjustment when the issue was first floated in the market, you had a quoted margin. And because the issue is priced at par, so the quoted margin by default becomes the required margin when it was first floated in the market. Now, as I said before, that one of the two ways the adjustment can be done, either in the numerator or in the denominator. Okay. So if you do the adjustment in such a way that the issue still is being floated at par when the market interest rate changes, you adjust the coupon accordingly. When you do that in such a manner that the issue is now still floated at par, then the curve that can be derived from such adjustment is called the par curve. The par curve. And at every resetting, the adjustment that you will be doing, these two put together is the par rate. So the par curve is nothing but a series of par rates such that the issue is always floating at par. So adjustment is happening in the numerator. Okay. Again, a very important concept of the term structure, and within this term structure, what is meant by spot, whiting, forward rates, etc. So before that, let me get you something called as the pure expectations theory. So it's an economic concept. You will definitely, unless you have already studied, you would have studied this, or you will study this subsequently in your topic area of economics. Pure expectation theory is a very important concept altogether, and it is being regularly applied in various aspects of finance. Okay, all that it means is, let's say you have a choice, and the choice is that you could invest in a security for, let's say, 2 years directly. That is, you can invest into the spot rate of 2 years. Or you could do one thing. You could invest into the security for spot rate of 1 year. And after 1 year, whatever be the spot rate from 1 year to 2 year, you can invest it again. So that means you can break your investment at the end of 1 year, and then you can invest in another year. Okay, this second breakage could be for 2 years or 3 years or 5 years. It doesn't matter. I'm just taking a simplistic example to drive home the point. Now let's assume that the first spot rate for 0 to 1 year, so 0 to 1 year, let's say the spot rate is 5%. Okay, and the 2 years spot rate is, let's say, 6%. Okay, now between 1 year to 2 year, can the rate be anything arbitrary? Think about it. The answer is definitely no. Why? Because if it is so, then arbitrage will come into picture and exploit the opportunity. How? Let us do the math. So let's say I have an option to choose between investing in a couple of securities, one which has a lock-in period of 2 years, yielding me 6%, and another wherein I can invest it in for 5 years, invest it at the rate of 5% for first year, and then thereafter, whatever will be the spot rate at the end of the first year for another year, I'll be investing in that. So in the first security, for the mere virtue of me investing it for a couple of years will yield me, let's say I invest $100, so it is going to yield me 1 plus 6% square, right? So this becomes 112.36. This is my absolute yield after the end of second year. And if I invest in the security for only 1 year, I'm going to get 100 into 1 plus 5%, which is 105. Now let's say between 1 year and 2 year, the yield available is, let's say, 8%. Okay, so then what I could do is that I could invest it for 1 year, break it after 1 year, and then invest this security at the rate of 8% for 1 more year, and the yield will be $113.4. Okay, 113.4 is exactly $1.04 more from 112.36. Okay, now since we are talking about spot rate, so basically this is default for government securities. If this were the case, this 8% was chosen arbitrarily. It could have been 9%, it could have been 5% as well. Doesn't matter. Okay, so I just off the hat gave you the figure of 8%. But if it was so, and if we had the luxury of investing in the government securities, the G-Secs, yielding in this manner, then you clearly see that investing in breaking it and then investing it, of course, we are going to ignore the tax implication altogether. But investing it in this fashion is going to yield me more. It sounds to be more profitable. The source is the same government security. If that be the case, then I could borrow indefinitely from government. Which is to say that I would invite the government to invest in my securities, wherein I'm only going to pay him at the rate of 6% because 6% happens to be the spot rate. And then I can reinvest in the same government by breaking my investment every year and then investing it for 1 more year to earn this additional $1.04 more for every $100, which is 1.04%, right? Every year. Imagine I multiplying it by billions and billions of dollars. It becomes completely risk-free for me, right? So you could see the anomaly out here. Who is losing in this process? Of course, the other party, the government, is losing in this process. So that is to say that this 8% obviously cannot exist arbitrarily, right? There has to be some equivalence out here such that the yield for any investor to be indifferent between investing in for 1 year, breaking that investment and investing in for one more year should be equivalent to investing it for 2 years completely. So the investor should be completely indifferent towards this. To maintain this equality, to maintain this status quo, that would mean that the spot rate from 1 year to 2 year cannot be an arbitrary 8% or 7% or 6%, any just number around. It has to be something inbuilt. It has to be something justified. Okay. Otherwise, arbitrage will play and make merry, right? So how do we go about it? So if the investor has to be indifferent between these two securities, that means we are now going to say that this is a forward rate. Okay, we are no longer going to tell this is a spot rate because this is a forward rate. So the forward rate from 1 year down the line for one more year must then equal the total amount of investment for 2 years. So it should be 1 plus 6% for 2 years must be equal to 1 plus 5% for year 1 multiplied by 1 plus 1 year down the line, 1 year forward rate for one more year. This equivalence must hold. If this equivalence holds, then only this spot rate gets derived and falls in line so that arbitrage cannot take place. Okay, and nobody loses, least of all the government. So if you do this math, let's see what is the forward rate that is coming out to be. So we have 1.06 divided by a square divided by 1.05, and this comes out to be roughly around 1 year forward rate 1 year from now roughly comes around 7%, which is to say that the spot rate between year 1 and year 2 will be approximately 7%. It cannot be arbitrarily 8% as we have depicted before. No. Okay. So this is the very basis of what is called as the pure expectations theory. The pure expectation theory, all that it says is, in layman terms, is that an investor is indifferent between investing in two securities where the yield are going to be same regardless of how many times you actually break and reinvest. It's the same as the effective annual interest rate as we have solved the problem in the preceding slides and preceding videos. Okay, so for illustrative purposes, I have drawn the spot curves and the par curve and the forward curve. So you remember what is a par curve? So par curve is nothing but the adjustment in the coupon in such a manner that the issue is always going to float at par, but obvious they are going to be little less than the spot rate. Spot rate of what? Spot rate of the issue itself I'm talking about. It may or may not be the government. Okay, so here the spot rate is a bit of a misnomer, you can say, because we are directly comparing the par rates with the spot curve until and unless it's a government security. It's a government security, then yes, the par curve is a little less than the spot curve because it is adjusting for the coupon at every resetting date in such a manner that the par value is equal to the face value, and hence it should yield the least. And the forward curve is the one which you can see that it initially humps and it initially peaks at around 5 years and a dime. It's just in a time scale that I'm mentioning. It's 5 years is just a point and figure to drive home the point which I'm trying to tell you. Evidently, what you need to understand at any given point in time, the forward rate is at least equal to that of the spot rate. Okay, no less than that. Okay. Different measures of the benchmark yield. Of course, we talked about the G spread. G spread is spread of an issue over the corresponding G6, which we have talked in detail. only the recently issued most liquid securities are considered for the GSEC, the treasury securities, of course, to serve as the benchmark. And then there is something called as I spread and Z spread. So we're going to touch base upon these two. These are going to be, again, very important. Now, typically also what happens is that, if my tenor of bond is, sufficiently of a long horizon, I may not always find a corresponding GSEC which is outstanding in the market and yet liquid. It may not so happen. Secondly, the GSEC at any given point in time may only be for fixed maturity or key date maturities of 5 years, 6 years, 7 years, 10 years, something like that. There's no such key rates which are available at, let's say, 5.25 years or 6.67 years. However, there are international transactions that happens daily across the world basis on something called as the swap spread. So the swap spread is basically a nomination. Swap spread is basically wherein you could think of two governments. The best way of thinking about swap spread is basically wherein two governments, this is government one and this is government two, they have bilateral trade that's going on, and in order to facilitate those bilateral trade, they have drawn a swap curve between themselves. So all that it would mean is that they this government one exchanges some principal in his home currency with government two, and government two also exchanges the same amount of principal in its home currency. When you do that, so both of them are, both of them owe each other equal amount of money, and it really doesn't matter where the interest rate, where the exchange rate goes, because the value would remain same at the end of the tenor. Now, in this two situation, in such a situation, the order to facilitate any sort of bilateral trade, or because there are corporates that are involved, they are facilitating, they are regularly engaging between trade between one government and another government trades. In order to facilitate them, they need certain reference interest rate. So that reference interest rate gets built into something called as swap. Okay, why it is called swap? Only for one reason, that they have swapped their principals at the very beginning. So their principals are completely immune to any sort of distortion as far as the exchange rates are concerned. The pure interest rates differential between two governments may subsequently drive the swap spread. That's the very basis of it. Okay, so why this swap spread is important for us is because, as I said, that you may not find government securities outstanding for your given horizon. My horizon at any given date might be only for 5.5 years, or let's say it is for, 22 years, 8 months. So in such kind of oddball, there may not be existing a government security which can serve as a benchmark. So in order to facilitate that, sometimes we make use of something called as the swap spread. So swap spread is nothing but, then again, this, because swap spreads are available for all maturities conceivable. That's the beauty of it. Liquid or not, it's available for all maturities that one can think of. Okay, from an overnight security to 1 month, 3 days, to 22 years, 8 months, 22 years, 9 months, whatever be the case, it's available. Since these are available, so they can always serve as something called as a reference benchmark. Okay, and because it's being exchanged between two governments, hence the credit spread between them are practically zero, because nobody really owes anything. If he cannot default, because they're not going to gain anything out of this by defaulting. Okay, so if this be the case, so in absence of the equivalent or relevant benchmark being provided by the government securities or the TSECs, the swap spread can come into picture. Okay, so there are interpolated spreads expressed as domestic currency only. Swap spreads are popular because they're available for almost any conceivable maturity and can be custom bills. There may not be enough government on the run GSECs available for interim or fractional maturity, giving rise to these instruments, as I mentioned before. And any spread over and above this swap spread gets built into the YTM of the security under consideration. So all that we are doing is that we are replacing the benchmark of the GSEC with the corresponding swap curves of the country. Okay. Z spread. Remember, we talked about the par curve. In case of par curve, what we did, we adjusted the coupon in order for the security to float at par, right, at any given instance. Z spread takes a little bit different approach. All that it says is that it is the constant spread being added to the denominator. Mind you what I'm saying. We are not talking about the denominator. No, you have the cash flows, and the cash flows get adjusted by the discount factors, right? That's the very basis on which the pricing of a bond is being ascertained, right? We discussed that at length. Now, what are the components of this discount factor? This discount factor, as we say, that this is the benchmark yield, plus there could be required margin as well. Okay, so required margin is nothing but the spread of those risk factors in column B, right? You remember that, right? So these are the components of the discount factor. Okay, the benchmark yield, the required margin. Now, this is obviously ever changing, required margin. Now, in case of the floating rate note, the required margin is always so set that the issue floats at par. But what if I tell you that I need a spread only such that the all required cash flows, remember what I'm saying, all the future receivable cash flows, when they are summed up after discounting to their present value, must equal to the current market price. So there is a difference. So here I'm not talking about the par value. I'm not even talking about the face value. I'm not even talking about the present value being equal to the par value. All that I'm saying that the market has a certain price of the bond, okay, which I consider as the present value of the bond itself. Now, if I have to devise a discount factor in such a fashion that this discount factor is such that, let's call this discount factor X, that if we add up all the cash flows leading up to the maturity, this discount factor will equate all this cash flow to the present value or the present market price of the security. So the adjustment is being done not here, because this portion is that of the coupon. The adjustment is being done at the denominator end. Okay, so what do we do? Again, what are the components of this discount factor? The benchmark yield, of course, we talked about, plus the spread. The spread is reflected in the required margin. But in this case, the spread are going to be adjusted in such a manner, that we will say that there is a constant spread of Z. A constant spread of Z is being added in such a manner that all the cash flows, when they are added, put together, suitably discounted, will equate to the present value of the current market price of the security. Okay, so that portion of the discount factor is called the Z spread or the zero volatility spread. So mathematically, if I have to draw this, it is something like this. So we know in case of a bond value, if it is an FRN, so FRN is nothing but the cash flows. Here the cash flows are obviously adjusted suitably as per the quoted margin. If the quoted margins are altered every time, such that the FRN is equal to the present value is equal to the face value is equal to 100, if that's the adjustment being done at the coupon end, so we say that the adjustment has done as per the par curve. Okay, so we have this, and then the discount factor. The discount factor is nothing but the function of the required margin itself. The required margin is again going to be the spread which we have discussed so far. Okay, so this is how FRN is being priced, right? We sum all of them. So we have the year 1, we then have the cash flow suitably adjusted for the quoted margin in year 2, again a discount factor suitably adjusted with the required margin for that period, and so on and so forth. Suitably adjusted quoted margin. This is again discount factor, which is a function of the required margin. Okay, this is how we are priced, such that this value is always 100. That was the very notion of the floating rate note. Now, just extend this concept with the only exception that replace this face value of 100 with the current market price. The current market price may be 100, less than 100 or more than 100, doesn't matter, okay? But whatever be that current market price, we are concerned with that only. So in the numerator, of course, this is the coupon that is being received. There is no change in the coupon. But in the subsequent denominator, the discount factor is so adjusted that a constant spread replaces the discount factor such that when you discount in this fashion and arrive at the present value after summing them up, it equates with the current market price. If such a spread can be found, that spread is called as the Z spread of the security. Remember, between required margin and Z spread, there is not much of a difference anyway. Okay, both of them put together sometimes are also called as the nominal spread. Okay, so the Z spread will embed all those elements as that of the required margin. The only exception being that it need not necessarily be such that the value of the security is pegged at the face value. It is but contingent on the market price of the security. Okay. Let's do a quick math in order to elucidate the concept here. So we take this example of government of Bolivia, and what it talks about is the government of Bolivia has issued a 2-year security that pays 5% coupon annually. The issue is trading at 101.5 point per 100 face value of BVR, and there is a mining corporation called Sarhozi that has bond trading at 103 per BVR 100, paying 7% coupon. The corresponding spot rates are S1 at 4% and S2 at 4.5%. What are the YTM of GSEC and the Sarkozy bond, and what are the Z spreads of the GSEC and the corporate bond? Okay, so let's attempt the problem here. So in this case, let's first draw the timeline. We first take the GSEC. So it's a 2-year security. The GSEC pays 5% here, 5% here, and 100% of the principal here. Okay, so the issue is trading at 101.5, and the spot rates that are being given are spot rates for 0 to 1 has been given. This spot rate is 4%, and spot rate for 0 to 2 has been given, and this spot rate is of 4.5%. Okay, now let's first define what is the theoretical fair price of this government security given these two spot rates. So it is very simple. The theoretical fair price of this security should be equal to 5 divided by 1 plus 4% plus 105, which is equal to 5 plus 100 divided by 1 plus 4.5% square. Okay, so if you do this math, the present value of the security comes out to be 100.95. Okay, the present value of this theoretical fair price of this security comes out to be 100.95. However, the current market price of this security is not 100.95, but it is equal to 101.95. Right? Now, first we find out what is the YTM of this security given this 100.95. So it is very easy. All that you have to do again is input all the details. Which are those details? N is equal to 2. Sorry. N is equal to 2, and the PMT, that is the payment each term, is going to be 5. FV is by default 100. Present value of this security has been found, gleaned out from the spot rate at 100.95. So if you input these details, the YTM of this security, let's see. YTM of the security comes out to be 4.49%. 4.492%. So this is the YTM of the security. However, the security is being traded in the market at 101.95. So what we do is we simply replace this 100.95 with 101.95. Okay, so we say 101.95 is the present value. Just change that and then CPT I by Y. So when you do that, the I by Y, or the yield to maturity of the security according to this current market price of the security 101.95 is equal to 3.966%. Okay, 3.966%. Okay, so where is the catch? So if we go by the spot rate and we discount the fair value, discount the cash flows, and come out with the fair value of the security is found to be yielding at 4.492%. That is the yield to maturity of the security when it was issued. Okay. However, the issue, for 2 years to maturity. However, the issue is currently trading at 101.95. Okay. So if we go by the definition of Z spread is basically that amount of spread which, when added to the discount factor, equates all the cash flows of the security to its present value. So if we do this math, 101.95 being the present value and the cash flows are 5% divided by some discount factor here, so in this discount factor the Z spread will be embedded. Now we have already found out the YTM of here, which is 4.492%. It is the fair value YTM, and here the YTM comes out to be 3.996%, which is the current market price based YTM. So all that we have to do is to see that the YTM out here is nothing but if you the Z spread is nothing out here, but if you deduct the YTM based on the current market price vis-a-vis YTM based on the theoretical fair price. Okay, that is the Z spread. So 3.966% minus 4.492%. So that comes out to be minus 0.53% or minus 53 basis point. Okay, this is again an important concept. So all that it says is that here the Z spread is in the negative. Yes, it can be in negative as well because the market is valuing the security more than its theoretical fair price. That is why the price of the security is 101.95 instead of 100.95. Hence, the Z spread must be negative. Okay, that's how we find out Z spread. I hope through this the concept of Z spread should be abundantly clear. I can assure you that this kind of examples are not even quoted in the CFI text, but through my learning, my own days of actually struggling through these concepts, because fixed income is pegged to be one of the hardest subjects. I do not understand why. Now, but I can see precisely why it is so, because sometimes some of the concepts are very obscurely written in the text as well. That's my own personal experience. I'm not passing any judgment. Okay. So what are the YTMs of G6 of the G6 and the we found out the YTM. We also found out the Z spread. Can we do the same for the corporate bond of Sarkozy as well? Yes, of course we can do that. And as an example, as an exercise, I leave it to you to find that for Sarkozy Enterprise, the corporate, it's YTM as well as the Z spread of Sarkozy as well. okay, and then come back to me. Similarly, there is one more example, the last example that has been given. ABC Corporation has issued a 5-year straight bond paying annual coupon of 7%, while its sister company XYZ has issued a callable bond that is similar to all aspects to the above bond but pays a higher coupon. But obvious, the 5-year spot rates are mentioned here. An analyst has determined the Z spread for both bonds over the reference LIBOR curve. The ABC bond Z spread has been determined to be 124 basis points, while that of XYZ is determined at 162 basis point. What is the value of the call option on the XYZ bond? Now, I want all of you to come out to solve this problem, um, and then come back. I'll just drop a hint here, and the hint is that you will have to find out the Z spread between two securities, okay? And if you have found out the Z spread between two securities, the key word out here is the sister concern. ABC and XYZ, they are sister concern. That means that the credibility in the market, for all the practical reasons, can be assumed to be same. Okay, so if that be so, then do we really need to do the math, or we can simply find out the Z spread? But we can simply find out the call option, the value of the call option by taking the difference between Z spread itself. Okay, I leave it at that, and I want all of you to come back to me. I can be reached. Sorry, it's 1. I can be reached here with your answer. And that brings us to the end of this session on fixed income valuation. I hope you like this 3-part series of fixed income valuation. Leave your comment and let me know how I can make your experience of learning through the CFA program more interesting and more helpful. Thank you very much.